Estimating working capital needs. The size of the company's investment is in current assets and is determined by its short-term financial policies. There are three types of policies that the company can use: flexible policy, restrictive policy, and a compromise policy that lies between the two. A company keeping a flexible working capacity capital policy means that the company is very liberal in its trade terms and has invested a large amount of funds in its operations. Flexible policy actions include keeping large cash and securities balances, keeping large amount of inventory, granting liberal credit terms. Second, a company keeping a restrictive working capital policy is basically investing the lowest amount possible in the operation. For restrictive policy actions include keeping low cash and securities balances, keeping small amount of inventory, allowing few or no credit sales. Third thing is that a company keeping a compromise working capital policy is realistically investing the money in the operation neither has very large amount of cash nor runs always short of it like a restrictive policy does. The three types of policies are shown in the figure. Figure is blank. Blow. As you can see in the as you can see in the figure 18.1, a company that keeps a flexible policy keeps enough liquid assets that are sufficient to finance its peak requirement of working capital. This means that the company invests the excess amount money that it has when there is less than the peak demand. A company with a restrictive policy keeps enough liquid assets that are sufficient to meet the lowest level of working capital requirement. This means that the company borrows as the seasonal needs grow to fund fund its working capital needs. With a compromise policy, the firm keeps a reserve of liquidity which it uses to initially finance seasonal variation in current asset needs. Short-term borrowing is used when the reserve is exhausted. The restrictive policy is associated with higher risk and higher expected profitability. A conservative policy ensures higher liquidity and cover risk but always accompanied by lower profitability. The policy to be adopted is based on the management perceptions of the risk and with a view to maximize the utility value of the funds used in the working capital management. This means that the risk return trade-off is to be kept in mind while formulating the WC policy. Flexible policy means that the company is carrying excess cash and hence bearing higher carrying cost that the other two policies. Restrictive policy means that the company is not out of cash many times and hence carries shortage one cost of hence like loss of orders etc. This is depicted in figure 3.2 below. As as the level of working capital increases, shortage costs go down while the carrying cost increases. This means that there would be a point where the sum, sum total of carrying cost and the shortage cost would be the lowest. This is the optimum level of current assets that the company should keep. In addition to the working parameter peculiar to a company that determines the quantum of required working capital, the following factors are also equally important. Profit levels. A company earning huge amount of profits can add to the working capital pool a large quantum of funds. Such companies should, however, guard against the temptation of expanding beyond necessity and tying up the funds in unproductive capital expenditure or allow unnecessary increase in overhead. Generally, it is seen that companies with high profit levels become less in management, lacks in management of funds and usually mismanaged by blocking funds excessively in stock or debtors. Tax level and planning. Income tax laws provides for payment of advanced tax in installments. Excise and sales tax are payable at a time of dispatch of goods from the factory premises and the point of sales respectively. Any working capital management must be adequate and timely provision for the same as of the same as all of them involves cash outlays. A third thing is dividend policy and retained earnings. Dividend policy and retained earnings. Dividend policy and retained earnings are directly related. There has to be a proper balance between the need to preserve resources and the obligation to satisfy shareholder expectations. Sometimes reserves are sacrificed for consistent dividends. Dividends, once declared, become a short-term liability which has to be paid for in cash, and this impact should be recognized in the working capital budget. On the other hand, it would be of little satisfaction to the general body of the shareholders to enjoy a liberal dividend at the expense of plowing back the same for growth of the company. Reserve in the form of returned earning is very important source of augmenting working capital. The fourth one is depreciation policy. The extent to which depreciation provision is made during the course of making the financial statement has a direct bearing on the dividend policy and retained earnings. This is because a higher quantum of depreciation would leave lesser profit returns, result in reduced retained earnings and dividends. A quantum of depreciation can be made to vary by choosing different methods to provide for the use of assets. As provisions for depreciation are actually only book entries and represent no cash inflows at the time. They will have no bearing on working capital except to the extent they may hold back distribution of dividends. Fifth thing is expansion diversification plan. Fifth thing is expansions diversi- diversification plans. Addition of fixed assets to produce new products. Resorting to multiple shifts or marginally adding to the plant and machinery. are some of the common known ways to expand or diversify. Other, either, either of them represent an increase in production, which calls for a higher quantum of spending of current assets. Example, you buy more raw material when you produce more and so on. In such situation, it is unwise to strain the internal resources for avoiding external funding. Price level changes in raw material and finished goods. Inflation has got a direct bearing on the working capital. It depends to a large extent on the company's abilities to adjust its own prices to cover the increase in the cost. In case the product or service requires government approvals or is administered as far as the price concentrated. Inflation may have a very significant bearing on the working capital needs. Inflation could be either recessive or expensive. During recessive inflation, the companies are unable to sell more products due to the lack of demand, which results in the reduction of production. Inventories pile up and fixed expenses need a drastic reduction. Operating efficiency of the company. Operating efficiency of the company plays a major role in working capital management. An efficient company will have a shorter manufacturing period, long credit terms available from suppliers, and minimal customer credit outstanding. If this is achieved, then the quantum of working capital required will be naturally reduced. Vigna. Now we'll talk about the working cycle capital. Working the working capital cycle. The working capital cycle or operating cycle is the length of the time between a company's paying for material entering into stock and receiving the inflow of cash from sales. The movement in the capital cycle are different for in different types of companies and are dependent on the nature of the company. Cash cycle, operating cycle, you can see the figure is inventory sold, cash received, inventory purchased. The operating cycle is the time period from inventory purchase until the receipt of cash. Sometimes the operating cycle does not include the time from placement of the order until the arrival of the stock. The cash cycle is the time period from when cash is paid out to when cash is received. Now we will talk about the computation of working capital. The two components of working capital are current assets CA and current liabilities CL. They have a bearing on the cash operating cycle. In order to calculate the working capital needs, what is required is that the holding period of various types of inventories, the credit collection period, and the credit payment period. Working capital also depends on the budgeted level of activities in terms of production sales. The calculation of WC is based on the assumptions that the productive production sales is carried on evenly throughout the year and all cost accurate occur similarly. As the working capital requirement are related to the cost excluding depreciation and not to the sold price. WC working capital is computed with reference to cash cost. The calculation of WC working capital is based on the assumption that the sales production is carried on evenly throughout the year and all costs occur similarly. As the working capital requirements are related to the cost excluding depreciation and not to the sold price. Working capital is computed with reference to cash cost. The cash cost approach is comprehensive and superior to the operating cycle approach based on holding period of debtor and inventories and payment period of creditors. Some problems have been solved. However, using the operating cycle approach also, a step involved in estimating the different item of CA and CL are as follows. Estimation of current assets. Raw material inventory is the investment in raw material inventory is estimated on the basis of question 1. Budgeted production in units multiplied by cash cost of raw material per unit multiplied by average inventory holding period months by days 12 months 365 days. Work in progress inventory, the relevant cost to determine work in process inventory are the proportionate share of cost of raw materials and conversion cost, labor and manufacturing overhead cost excluding depreciation. In case full unit of raw material required in the beginning, the unit cost of work in process would be higher. That is, cost of full unit plus 50% of the conversion rate conversion cost compared to the raw material requirement throughout the production cycle. Work in process, normally called as W by P, is normally equivalent to 50% of total cost of production. Symbolically, bu- budgeted production in units multiplied by estimated work in progress cost per unit multiplied by average time span of work in progress inventory months by days. 12 months 660 by days. Finished good inventory. Working capital required to finance the finished goods inventory is given by factors summed in equation 3. Budgeted production in unit, cost of goods produced per unit, excluding depreciation. Finished good holding period months by days, 12 months 665 days. Debtors. The WC tied up in debtors should be estimated in relation to total cost price excluding depreciation symbolically. Budgeted credit sales multiplied by in units multiplied by cost of sales per unit excluding depreciation multiplied by average debt collection period months by days, 12 months multiplied by 365 days. Cash and bank balance. Apart from WC needs for financing inventories and debtor, firms also find it useful to have some minimum cash balance with them. It is difficult to lay down the exact procedure B of determining such as amount. This would primarily be based on the motives for holding cash balance of the business firm, attitude of management toward risk, the access to the borrowing sources in times of need and past experience and so on. Now we'll talk about the estimation of current liabilities. The working capital needs of business firms are lower to the to the to the debt. Exact such needs are met through the current liabilities other than bank credit arising in the ordinary course of business. The important current liabilities CLL in this context are trade creditor, WAGs, and overheads. Trade creditor budgeted yearly production in units. Raw material requirement multiplied by raw material requirement per unit multiplied by credit period allowed by creditor months by days. 12 months 365 days multiplied by 12 months or 365 days. Note: proportion adjustments should be made to cash purchase of raw material. Direct WAGs budgeted yearly production in units multiplied by direct labor cost per unit multiplied by average time lag in payment in WAGs upon 12 months or 365 days. The average credit period for the payment WAGs approximate to half month. Half in a month case of monthly WAG payment. The first day monthly WAGs are paid on the 30 days of the month. Extending credit for 29 days. The second day's wages are again paid on a 30 extend extending credits for 28 days and so on. Average credit period approximate to half a month. Overheads other than depreciation and amortization. Budgeted yearly production multiplied by overhead cost per unit multiplied by average time lag in payment overload. Overhead months by days upon 12 months or 365 days. Two amount of overhead may be separately calculated for different types of overheads. In the case of selling overheads, the relevant item would be sales volume instead of production volume. The computation of working capital is summarized in following format. Determination of working capitals. First one is estimation of current assets. Minimum desired cash and bank balances. Inventories, raw materials, work in process, finished goods. C. Debtors, total current liabilities. Second thing is EOCL, estimation of current liabilities. There are some keywords are creditors, wages, overheads, total current liabilities. The third keyword is point is that net working capital. Add margin for contingency. The fourth one is that net working capital requires If payment is received in advance, the item would be listed in CL, current liabilities. If advance payment is to be credited, the item would appear under CA. The same would be treatment for advance payment of works and overheads. Examples: X and Y Limited is desirous to purchase a business and has consulted you. And one point of which is you you ask to advise them. It is the average amount of working capital which will be required in the first year working. You are given the following estimates are instructed to add 10% to your computed figure to allow for contingencies. Now we'll talk about there are 4 points. The first point is average amount of backed up for the stocks, and the other side is what's written is that amount for the year. First one, average amount backed up for stocks. Stocks of finished product rupees 5,000. Stocks of stored and materials rupees 8,000. Now I'll talk about overhead other than depreciation and amortization. Budgeted yearly production in units multiplied by overhead cost per unit multiplied by average time lagging payment of overhead months by days, 12 months, 365 days. The amount of overhead heads may be separately calculated for different types of overheads. In the case of selling overheads, the relevant item would be sales volume instead of production volume. The computation of working capital is summarized in following format. Format 7, determination of working capital. Now we will talk about the estimation of current assets. A. Minimize minimum desired cash and bank balances. B. Inventory, raw material, work in process, finished goods. C. Debtors, total current liabilities. Second, estimation of current liabilities. A. Creditors. B. WAGs. C. Overhead total current liabilities. Third thing is net working capital 1 to 2. Add margin for contingency. Fourth is net working capital required. If payment is received in advance, the item would be listed in current liabilities, means CL. If advance payment is to be made to creditors, the item would appear under CA, current assets. The same would be treatment for advance payment of WAGs and overheads. Examples. 1. X and Y Limited is desirous to purchase a business and has consulted you. And one point on which you are asked advise them is the average amount of working capital which will be required in the first year's working. You are given the following estimates and are instructed to add 10% to your computed figure to allow your contingencies. Average amount backed up for stocks. Stocks of finished product is 5,000. Amount of the year is 5,000. Stocks of stored and materials is 8,000. Amount of the year is 8,000. Second, average credit given is inland sales is 6 weeks, credit is 3,12,000. Export sales 1.5 weeks, credit is 78,000. Third point is average time lag in payment of WAGs on other outgoings. WAGs 1.5 weeks is 2,60,000. Stocks and material 1.5 months is 48,000. Rent and royalties 6 months is 10,000. Clerical staff half month is 62,400. Manager half month is 4,800. Miscellaneous expenses is 1.5 months is 48,000. Fourth thing is payment in advance. Sundry expenses paid quarterly in advance is 8,000. Undrawn profit on average throughout of year is 11,000. Set up your calculation for the average amount of working capital required. Solution is statement to determine net working capital for X and Y limited is a current asset. First point is stock of finished product is rupees 5,000. Stock of stored and materials is 8,000. Third, debtors is inland sales is rupees 3 lakh 12,000 multiply by 6 upon 52 is 36,000. Export sale is rupees 78,000 multiply by 3 upon 104 2,250. Fourth point is advance payment of sundry expenses is 8,000 multiplied by 1 by 4 is 2,000. Total investment in current assets is for 53,255 rupees. B point is current liabilities. First point is WAGs rupees 2,60,000 multiplied by 3 by 3 upon 1.104 it 7,500. Second second thing is stocks or stocks material is rupees 48,000 multiplied by 3 upon 24 is 6,000. Third one is rent royalties rupees 10,000 multiplied by 6 upon 12 is 5,000. Fourth point is clerical staff is rupees 62,400 multiplied by 1 upon 24 is 2,600. Fifth point is manager rupees 4,800 multiplied by 1 upon 24 is 200. The sixth point is miscellaneous expenses is 48,000 upon 3 by 24 means 600. Total estimate of current liabilities CL is 27,300. C point is net working capital. First point is current assets, current liabilities CL, CA and CL is 25,950 rupees. Second point, yet 10% contingency allowance is 25.95. Average amount of working capital required is 28,545 rupees. The assumptions are that first assumption is that a time period of 52 weeks, 12 months has been assumed in year. The second assumption is that undrawn profit has been ignored in the working capital computation for the following reasons. There are two sections A and B. Two key points. For the purpose of determining working capital provided by net profit, it is necessary to adjust the net profit for income tax and dividend drawing and so on. Point B is profit need to allow be a source of financing working capital. It may be used for other purposes like purchase of fixed assets, repayment of long-term loans and so on. Since the firm does not seem to have such uses, rupees 11,000 may be treated as source of working capital, but the working capital will not change. The third assumption is that actual working capital requirement would be more than what is estimated here, as the cash component of current asset is not known. The second example is that a pro forma cost sheet of a company provides the following particulars. Element of cost: raw material, direct labor and overhead. Amount per unit is rupees 80, 30 and 60. Total cost is 170. Profit is 30. Selling price is 200. The following further particulars are available. Raw materials in stocks on average 1 month. Materials in process completion stage 50% on average half a month. Finish the goods and stock on average 1 month. Credit allowed by suppliers is 1 month. Credit allowed to debtors is 2 months. Average time lagging payment of tax is 1.5 weeks and 1 month in overhead expenses. 1/4 of the output is sold against cash. Cash in hand and at bank is desired to be maintained at rupees 3,65,000. You are required to prepare a statement showing the working capital needed to finance a level of activity of 1,04,000 units of production. You may assume that production is carried on evenly throughout the years and wax and overhead occur similarly. Solution is statement showing determination of net working capital. Current assets. First point is stock of material for 1 month. 1,04,000 multiplied by rupees 18 multiplied by 4.52 is rupees 6 lakhs 40,000. Second point is work in progress for half month. There are three points A, B, and C. A material 1,04,000 multiplied by 80 rupees 18 multiplied by 2.52 multiplied by 0.50 is 1,60,000. Labor. Labor 1 lakh 4,000 multiplied by rupees 30 multiplied by 2.52 multiplied by 50 point 50 is 60,000. Overheads 1,400,000 multiplied by rupees 60 multiplied by 2.52 is multiplied by 0.50 is 1,20,000. The second key solution is finish the goods for 1 month. 1 lakh 400 multiplied by rupees 170 multiplied by 4 upon 52 is 13 lakh 60,000. Third point is shown. Now we will talk about fourth point. Key solution is debtors for 2 months 78,000 multiplied by rupees 170 multiplied by 8 by 52 is 20 lakhs for 40,000. Fifth key solution is cash in hands at cash in hand and at the bank 3,65,000. Total investment in current assets 47,45,000. We we chatted we solution provide solution about current assets. Now we will provide solution about current liability CL. I creditors 1 month purchase of raw material is 1 lakh 48 1 lakh 400 4,000 multiplied by rupee 80 multiplied by 4 upon 42 is 6 lakh 40,000. Point two solution is average time lag in payment of expenses, overheads 1 lakh 4,000 multiplied by rupee 80 multiplied by 4.52 is 4 lakhs 80,000. Point B labor 1 lakh 4,000 multiplied by rupee 30 multiplied by 3 upon 104 is 90,000. Total estimate of current liabilities is 12 lakhs 10,000. Now we will talk about the current asset, current liability, and now we will talk about net working capital means net CWC is equal to current assets minus current liabilities. A minus B is 35 lakhs to 36,000. There are three working notes and assumptions. The first one is that 26,000 units have been sold for cash. Therefore, credit sales pattern is 78 to 78,000 units only. Second one is ERS 52 weeks. Second assumption is working note and assumption is all overheads are assumed to be variable. Presence of the depreciation element in overhead will lower the working capital required. Now we will talk about the third example. While preparing a project report on behalf of a client, you have collected the following facts. Estimate the net working capital required for that project. Add 10% to your compacted figure to allow contingency. Estimate cost per unit of production is amount per unit is raw material rupees 80, direct labor 30, overhead exclusive depreciation rupees 30 per unit is 60. Total cash cost is 170. What is the additional information is of this example is that they added additional information. Selling price rupees 200 per unit. Level of activity 1 lakh for 4,000 units of production per annum. Raw material in stocks average 4 weeks. Work in progress. Assume 50% completion stage in respect of conversion cost and 100% completion in respect of materials. Average 2 weeks. Finished goods in stock average 4 weeks. Credit allowed by suppliers average 4 weeks. Credit allowed to debtors average 8 weeks. Lag in payment of WACs average 1.5 weeks. Cash at bank is expected to be rupees 25,000. You may assume that production is carried on evenly throughout the year's 52 weeks. In WACs, in overheads occur similarly. All sales are on credit basis only. It's an example. Now we will talk about each solution. Net working capital estimates of a project. A. Current assets. B. Current liabilities. And C. Net working capital. Current assets. There are 5 points. Raw material in stocks is 1,04,000. 1,04,000 multiplied by rupees 18 multiplied by 4 upon 12 52 is 6,40,000. Second point is work in progress. There are three points: raw material, direct labor, and overheads. Raw material 1,41,000 multiplied by rupees 18 multiplied by 2 upon 52 is 3,20,000. Direct labor 1,04,000 multiplied by rupees 15 multiplied by 2 upon 52 is 60,000. See overheads 1,04,000 multiplied by rupees 30 multiplied by rupees 2 multiplied by 2 upon 52 is 1,20,000. Third point is finish the goods stock 1,04,000 multiplied by rupees 170 multiplied by 4 upon 52 is 13,60,000. Fourth point is debtors 1,04,000 multiplied by rupee 170 multiplied by 8 upon 52 is 27,20,000. Sixth point is cash at bank is 25,000. Total investment in current asset is 52 lakhs 45 to 45,000. Now I'll talk about current liabilities. 2 points. Creditors average 4 weeks 1,04,000 multiplied by rupee 80 multiplied by 4 upon 52 is 6,40,000. Second thing is lag in payment of WAGs is 1,04,000 multiplied by rupees 30 multiplied by 3 upon rupee 3 upon 104 is 90,000. Total current liabilities is 7,30,000. Point C, net working capital. Current assets minus current liabilities is 45 lakhs 15,000. At 10% contingencies 4 lakhs 51,000. So net is rupees 49 lakhs 66,500. What's a working note? Is note is that a full unit of raw material is required at the beginning of the manufacturing process, and therefore total cost of the material, that is rupees 80 per unit, has been taken into consideration. While in the case of expenses with direct labor and overheads, the unit has been finished only to the extent of 50%. Accordingly, rupees 15 and rupees 30 have been charged for direct labor and overheads respectively in valuing work in process. Get out of my life. A newly formed company has applied for a loan to a commercial bank for financing its working capital requirements. You are requested by the bank to prepare an estimate of the requirements of the working capital for the company. Add 10% to your estimates figure to cover unforeseen contingencies. The information about the projected profit and loss account of this company is under is as under. Sales rupees 21 lakhs. Cost of goods sold 5 lakhs 30,000. Gross profit is 5 lakhs 70,000. Administrative expenses is rupees 1 lakhs 40,000. Selling expenses is 1 lakh 30,000. 2 lakh 70,000. Profit before tax is 3 lakhs. Provision for tax is 1 lakhs. Note: cost of goods sold has been derived as follows. Material used 8 lakh 40,000. Wages and manufacturing expenses 6 lakh 25,000. Depreciation 2 lakhs 35,000. The total is 17,000. 70 lakhs. 17 lakhs. Less stock of finished goods is 10%, nor yet sold is 170 lakhs, 1 lakh 70,000, and total is so depreciation minus less stock of finished goods is that 15 lakh 30,000. The figures given above relate only to the goods that have been finished and not to work in progress goods equal to 15% of the year's production in terms of physical units are in progress on an average requiring full material but only 40% of other expenses. The company believes in keeping 2 months consumption of material in stock. Desired cash balance is 40,000. Average time lag in payment of all expenses in 1 month. Supplier of material extend 1.5 months credits. Sales are 20% cash. Rest at 2 months credits. 70% cash of the income has to be paid in advance in quarterly inst- installments. You can make such offer other assumption as you deem necessary for estimating working capital requirement. The fourth equation is completed now. An example. Now we will talk about its solution. Net working capital estimate of a company. Point A. Current assets. The first one is raw material in stock is equal to rupees 8 lakhs 40,000 multiplied by 2 upon 12 is rupees 1 lakh 40,000. Second thing is work in progress. Work in progress having 2 points A and B. Raw material 8 lakhs 40,000 multiplied by 50 upon 100 is 1 lakh 26,000. Point B, wages and manufacturing expenses is equal to rupees 6,25,000 multiplied by 0.4 multiplied by 50 upon 100. 30,000, 37,500. Third point is stock of finished goods. Rupees 1,70,000 minus rupees 23,500. That of 0.10 multiplied by rupees 2,35,000 depreciation. Right? So what is the subtraction is that of that is that 1 lakh 1,46,500. Fifth point is debtors. Cost of goods sold is rupees 15 lakh 30,000. Less depreciation is rupees 2 lakh 35,000 multiply with 0.9 is 2 lakhs 11,500. So total is that. So subscription of cost of goods sold and less depreciation is that 13 lakhs 18,000 500. Administrative expenses is 1 lakh 40,000. See, selling expenses 1 lakh 30,000. Total is 15 lakhs 88,500. Now we'll talk about the credit sales. 4 by 5 of rupees 15 lakh 88,500 is that 12 lakhs 70,800. 12 lakh 127800 multiplied by 2 by 12 is equal to 211,800. Cash required is 40,000. Total investment in current assets is 7 lakh 1,800. B. Current liabilities. The first point is average time lag in payment in expenses. There are some 3 point A, B, and C. Wages and manufacturing expenses is 6 lakh 25,000. The administrative expenses is 1 lakh 40,000. Selling expenses is 1 lakh 30,000. So total is 8 lakh 95,000 multiplied by 12 is equal to 74,583. Second point is creditors. rupees 8,40,000 multiplied by 3 upon 24. Is that 1,05,000. Total current liabilities is 1,79,585.83 rupees. Point C is net working capital is current assets minus current liabilities. A minus B. 5,22,217. Add 10% contingencies is 52,222. So total is 5,74,439. So what are the assumptions and working notes at the end is that there are two working notes and assumptions. First one is that depreciation is not a cash expense and therefore excluded from cost of goods sold for the purpose of determining work in progress, finished goods and investment in debtors. Since profit is not taken into consideration in our calculation as a source of working capital, income tax has been. Now we'll talk about the fifth and the last example of this chapter is that from the following projection of XYZ and limited for the next year, you are required to determine the working capital required by the company. Annual sales is rupees 14 lakh 40,000. Cost of production include depreciation of 1,20,000 is 12 lakhs. Raw material purchases rupees 7 lakhs 5,000. Monthly expenditure is 30,000. Estimated opening stock of raw materials is rupees 1,40,000. Estimated closing closing stock of raw material is 1,25,000. Inventory norms raw material 2 months, work in progress 1 by 2 months, finished goods 1 month. The firm enjoys a credit of half a month on its purchases and allow 1 month credit on its supplies. On sales order, the company received an advance of rupees 15,000. You may assume that production is carried out evenly throughout the years and minimum cash balance desired to be maintained is rupees 35,000. Solution. Statement showing determination of net working capital. Yeah, current assets. Cash balance is rupees 35,000. Inventory, raw materials, opening stock is 1,40,000. Aid purchase is 7 lakhs 5,000. Less closing stock is 1 lakh is 12,500. Annual consumption is 7,20,000. 2 months requirement is rupees 7,20,000 multiplied by 2 upon 12 is 1,20,000. Work in progress is rupees 10 lakh 18,000 multiplied by 1 upon 24 is 45 is equal to 45,000. Finished the goods is rupees 10 lakhs 80,000 multiplied by 1 upon 12 is 90,000. Debtors is rupees 10 lakh 80 lakhs 10 lakhs 80,000 multiplied by 1 upon 12 is 90,000 at rate. Total current assets is 3 lakh 80,000. Current liabilities trade creditors rupees 7 lakh 5,000 multiplied by 1 upon 24 is 29,375. Advance received from debtors is 15,000. Total current liabilities is 44,035 C. Net working capital A minus B. Current asset minus current liabilities is 3 lakhs 35,625 rupees. What are the assumptions in working note is that at the rate it it is assumed that there is neither opening or nor opening nor closing stock of finished stocks, and therefore cost of sales is rupees 10 lakhs 80,000 including depreciation. Monthly expenditure is excluded as the cost of production includes it rupees 7.2 lakhs raw material plus rupees 3.6 lakhs 6 lakhs other expenses at the rate rupees 30,000 per month. So the chapter working capital management is over now, and thank you for watching video, and keep supporting us, keep providing likes, show some your loves and comment section. Thank you for watching the video. Thank you everyone.